Hey guys, welcome to Let's Talk. I'm with my co-host Dimitri, and we just came back from a very nice and refreshing eToro Popular Investor Summit that was in Hampshire, in London area, about 1 hour from London, in a very beautiful location, where we exchanged a lot with other popular investors, but also with externals from BlackRock, SoftBank, Wellington, and we discussed a lot. And that was, if I remember correctly, that was right the week where Jay Powell, the chairman of the Fed, or was it the week before? The Fed was going to actually meet and announce the new interest rate. So we will discuss this topic a little bit later in the episode, the new monetary cycle and how to tackle it from an investing perspective. But first, we will talk a little bit about the quarter, Q3 2024, that is ending now. We're end of September at the time of the recording. September is almost over. September has historically been the worst month of the year. We do know that election September, so the Septembers before US elections, are much milder. They tend to actually be flat. We actually had a pretty good September this year, especially compared to the last several Septembers. So, Dimitri, what's your key takeaway from this quarter and from this month of September? I had lots of people, who were saying, should I just sell everything? Actually, I had even my mother asking me this. Should we close all the positions before September starts and just let September pass and then buy again? That would have been a huge mistake, right?
I mean, that's a huge mistake every time when you try to pick the timing and say, okay, you have to be right away in order to get that right, and then try to pick the bottom or the bottom of the sell-off or the pullback or whatever the case may be and get back in. That doesn't work usually. I mean, you can get it right every now and then if you attempt, but I would never attempt that, because if you ask me in July to predict how August and September will be, I would tell you it will be the opposite. We'll have a little bit of, going sideways in August and then going down in September. But obviously, that's not the case. It's like August wasn't a good month, and September is so far like what the S&P is up 1%, 2%.
1% exactly. Yes, the S&P is up a little bit more than 1%. There's still two trading days to go, so let's be careful here. And the pre-market today is very green, very nice. So it looks like we will end over 1% this month, maybe 1.5. So on an annualized basis, it's pretty good.
Yes.
Is between 10 and 20%. Return on an annualized basis. So it's really good. It's not the kind of month that you would want to, that you would want to be out of the market.
Yes. And the thing with selling, I don't know if you have this, but it's one of my of the things that I have problem dealing sometimes. If I sell a stock, then I might have trouble buying it again like soon. It has to be a huge change between the price I'm selling and the price I'm buying. So I don't know, and I never tried it, but I had sometimes had trouble selling one stock and trying to buy it back a couple of months later. I don't know if I can get that right, so that's why I don't even attempt to do what you just described. But some people do it, and some people are actually quite good with selling, know the seasonalities. They can go back to history and say, you know what, September 70% of the times it's red. I'm not taking any chances. Let me sell. And if I missed 1-2%, fine. But I rather lose 1-2% of green than get 4 or 5% of red, which is understandable, but that's not the way I operate when it comes to investing.
Well, in my case, I do have, a little universum of
Mhm,
stocks that I'm following. I don't know the number. It could be 100 stocks, maybe
mhm,
less, between 50 and 100 stocks that I'm actually following and following the news,
mhm,
and that I have alerts on when the prices are really interesting to enter them. So
mhm.
it can happen to me that I sell a stock because it got way too expensive. But then when I sell the stock, not because fundamentals change, but because it got very expensive, I leave an alert there that says, that will basically notify me when the price gets really interesting again. And then I will have to check if, the price is just the valuation that normalized or if something changed in the fundamentals. So I just leave an alert there. So I actually don't know if I ever sold a stock and then bought it again, but I always leave an alert when
Yeah,
I decide to sell a stock to reduce and to increase my portfolio concentration. I leave an alert there. So in those cases, yeah, you can re-enter a stock, but generally exiting all your positions because September might be bad and then re-enter is not a way to proceed because I don't know if you've noticed, but there's always one fear, there's always one big
yes.
risk. Um, you know, we hear sometimes, oh, there might be a recession soon. Should I just close everything and then re-enter later? Or, oh, inflation might rebound. Should I close everything and reopen later? Or, there's the US election coming now, and I'm hearing the same speech I heard about September. Should I, just close everything and do nothing? And just wait for the election and then buy depending on the candidate.
Yeah, I
And
mean,
this is something we wanted actually to discuss today together is how to tackle these US elections because that's probably the main risk now. Yesterday we avoided the government shutdown, luckily in the US. So that's postponed for December. So that's going to be another fear after the US elections. So there will always be a fear, right? But how do you tackle the US elections? Does it matter to you which candidate wins for your portfolio allocation?
I mean, it doesn't really matter which candidate wins or loses, um, because Wall Street is going to operate with a Republican with a Democrat, and history has shown that. Maybe you're gonna get a couple of percentage more uh, if one of the other wins. Based on my portfolio, I'm more tech, and tech is favorable more with a Democrat. The Republican is more the old school economy, the old economy, the banks and energy and all that, which I'm exposed in both, but it doesn't
Mm,
really make a difference to me if whoever wins. But until we get there, we're gonna get the volatility because as they do their campaigns and they're traveling around the country, and one company, one sector comes into play, they say they're gonna tax oil from whatever country with sanctions and all that. They make a comment, the sector takes a hit. That's how we get the volatility as we approach the election. They raise taxes, something takes a hit. So it's sector by sector, is not for the whole market, I believe, closing to the election, sector by sector. But we're going to have to deal with the volatility until November. Until then, I heard other people say, just sell, get out of it, leave the election to play out. They don't care who is the winner or loser. Just let the event be behind us without any craziness and any civil unrest. And when that is done, go all in, risk on, and then wait for a strong
mm,
end of the year, and then you're gonna get your performance there, which I don't agree anyway, because I just mentioned that's not
mm.
the way I do things. But until November, we should expect some volatility.
Mm. Yes, but actually, look, for those people that saying, they want to wait to know who's going to be the president to then make the investment choices. Look, let's go back to 2020. Sorry, 2016. Time flies. 2016 when Trump was elected. Um, it's quite interesting what happened. So imagine you in 2016, Trump just got elected. You would probably have bought, what would you have bought? Oil, banks, you would have gone with those, right?
Mm-hmm.
You know, the very old stuff, also industrials.
Mm-hmm.
But you know what actually outperformed during his term? And that's really interesting. Renewable energy,
Mm-hmm.
solar stocks, you know.
Yes.
We say how the Democrats are always supporting solar stocks, but I actually think the US president doesn't have that much influence
Mm-hmm.
on the economy as we might think. Very often, you know, we say that an economy is going to be completely different if it's one president or another, but it depends much more on real life here, where all the people and the businesses are dealing together. And
Yes.
at that time, and now it's still true, it made sense to install solar panels. The technology improved, the efficiency is much better, and there was a huge solar energy adoption, and it's still going on now. So even if Trump gets elected, I'm going to keep my solar stock. I like First Solar, but there are other very good solar stocks. So this tells you that you actually may have surprises. So during the Trump term, uh, banks and oil stocks performed actually poorly.
Mm-hmm.
The rates were very low. That was not great for the banks, for a lot of banks. I'm not talking about JP Morgan and the ones, you know, that make money from transactions where they involved in, but I mean the ones that make money from lending to retail people.
The
And
regionals, the small banks.
that
Yes.
yeah, exactly. um oil stocks performed very poorly, even though it's really the candidate of oil. I mean, the Republican Party is financed by big oil companies,
Mm-hmm.
but they tend to perform poorly because they give they hand out all those permits to the oil companies
Mm-hmm.
that drill and drill and drill and produce a lot of oil, and that makes the oil price actually go down, right? The
Mm-hmm.
regulation is in favor of big oil, and it's easier to manage a big oil company for a big oil CEO. That's why they finance the Republican Party, and there are less fines, there are less, less punishments against big oil companies. But fact of the matter is that oil prices tend to go down. So you actually might be surprised. Even if you know who's going to be the candidate, you're not going to know which sectors will outperform in the next couple of years. Look at Joe Biden. I mean, I have respect for the man. He's now, he had many years of public service, many decades actually of public service. He started more than 50 years ago
Mm-hmm.
his public life, and he's now retiring. Who would have thought at the start of his mandate that the best performing segment would be AI?
Yes.
Biden has nothing of AI. He's really from middle of the 20th century. That's when he grew up. He didn't do anything in particular to promote AI or data centers. So in the end, it doesn't matter at all who's going to be the president, because um, the businesses will, and the economy in general will evolve the way that it kind of wants to evolve based on demand and supply and based on a bunch of other factors. And it's not going to matter who's the president. Is the president a red one or a blue one? So that is my opinion. That's how I see it.
That is correct, and I agree with you. And I'm going to give a couple of examples that illustrate that. I don't know. I'm sure you remember the Affordable Care Act, known as Obamacare. So when Obamacare came around, when they were trying to push it to vote it into law, they were claiming that healthcare costs would come down dramatically. The exact opposite happened. The healthcare cost went up
Mhm.
300%, I believe, in 5 or 6 years. So the healthcare sector doubled into the S&P only from the introduction of the Affordable Care Act. That's number one. Number two, I was in New York 2016. I remember the night I was in front of the TV watching CNN when Trump got elected, and I couldn't believe it either. I thought it was a
Mhm.
joke until 2 days earlier. And he got elected, and all the all the talk was that the market was going to tank the next day. The market was going to take a hit. We're going to a depression and all that. So the next day comes, and I remember clearly Bill Ackman, the hedge fund manager, coming on CNBC and says, "You know what? Trump's president, and I'm very bullish." and then the market start that crazy way up in the in the
Yes.
beginning. So you can't say that thing is going to go this way or the other way. You can't predict these things. And sometimes the government gets involved into a sector, they try to fix it and they make it worse. So,
Yeah. That reminds me a little bit. It's funny. I mean, we hadn't planned to discuss this on this episode, but the government planned to subsidize Intel
mhm,
for the chips,
yeah,
right? To produce them here in the US and depend less on Taiwan and
mhm,
less on, Chinese rhetoric.
yeah,
And well, we see what's happening to Intel now. It looks like the company is trying to sell itself for parts, sell a little bit to Qualcomm, sell a little bit to AMD, and so sometimes when the government gets involved, even with money, with favorable regulation, it's
mhm,
not always favorable to the companies in question. I'm not saying it's because of the government that Intel is failing, but maybe the fact of receiving, I don't remember, the subsidy is like something like $5 billion.
yes, yes, 5 billion.
Perhaps they rested a little bit on business efficiency. They were like, you know what, we're too big to fail. We're gonna get subsidized by the US government. We don't need to change the way our business operates. The government needs us. They're gonna give us money, and we, Intel, we just need to, keep our name of Intel, and the government is gonna keep supporting us. And that's a little bit also the mentality that was back in 2008, before the global financial crisis, when you had these big banks that thought they were too big to fail, and they were sure that the US government would bail them out. So you have this mentality sometimes when the US government gets involved. I also mentioned with oil prices,
Mhm.
US government makes regulations in favor of oil, but it ends up being quite bad for oil earnings because all the oil companies start producing a lot of oil, too much oil for the demand. So, sometimes it can go one way or the other, and you don't always know.
Yeah, you know what? I'm not going to be bullish on oil if Trump gets elected because he's going to give permits to everyone that wants to drill in his backyard. Okay. The oil price is going to go down. It's going to be good for consumers, but it's not going to be good for investors. Okay.
Mhm.
If the other thing happens and Kamala Harris becomes president, it's not going to give permit to anybody. Okay. Then the supply is gonna shrink. Then the oil price is going to be 140, 150, 160. It's good for us, for the investors, but not good for consumers. We are not consumers. We are
Mhm.
investors. So you have to think as such. So in
That's
some
right.
cases, you can kind of see where it's going, but still you're making a risk, making a judgment call on an investment based on probabilities which one is going to win because we don't know. And
Mhm.
I don't trust the polls. I don't trust them. I don't trust them.
Mhm. Yeah. No, the polls, if you remember the polls, they said that Clinton would win, and
Yes,
very easily she would win against Trump. And then, the rest is history.
yes.
So we don't know what's the outcome, and there's no way to know. And whatever the polls say, I'm not even sure what they say because I try not to follow them
Mhm.
anymore. I don't follow them anymore. And anyway, you have a lot of polls that contradict themselves and that change, the night before the election even. And and a lot of the people that are undecided, they anyway don't answer the polls because they're undecided and they make their decision the day before or the same day, and then this completely changed the outcome of the election. And especially in the US, it's enough if one state turns red or turns blue
Mhm.
uh, when it was not planned that it would turn that color,
Yes,
to completely change the election outcome.
yes.
And Trump won the election. It was a landslide against Clinton.
Mhm.
Clinton was supposed to win on a landslide, but Trump
Yes.
won it because he managed to, bring home states that were not expected to vote red. I'm thinking here Michigan and Wisconsin and states
Yes.
that no one would have imagined that they would vote red. And I think he even got Pennsylvania, which was also, a very
Florida.
democratic state. Virginia was a bit a surprise, was they often vote red.
Mm-hmm.
In the last couple of elections, they've been voting blue, and they voted for Clinton, if I remember correctly. So you had those surprises, and it's just a couple of percents that caused, one
Yes.
state to turn differently from the color. But not to go too political, yesterday I listened on CNBC. I listened to Tom Lee. Tom
Yeah.
Lee is a very respected voice
Mm-hmm.
in the investing world. He's the managing partner of Fundstrat Global Advisors.
Yes.
I think you can define him as a perma bull. He's
He's
always saying his target for the S&P 500 is always the highest from anybody
yes.
else. And something crazy happened yesterday. Like I couldn't believe my ears. I had to, check if my ears were working. The guy there, I don't remember who, but working from CNBC, asked Tom Lee, so do you think that the S&P will reach 6,000? So now the S&P is already at 5,700, something like that, right? There's only 5% or so to go to
Yes.
reach the 6,000. So it's not much. And we have 3 more months to go.
Mm-hmm.
And usually we have a very nice rally in November and December.
Mm-hmm.
And he refused to say that this was his target, that he he basically said he doesn't see, he's not very bullish on the stock market in the short term. And this is because there is the US election in November. So
Yes.
what's the link here? And can you try to unwrap his mind? Because he didn't exactly explain himself. He just said that there's the US election and he is not so sure that it's going to be, I don't know. In my opinion, when there's a US election, both candidates will continue making promises. Do you remember Trump made promises about crypto and crypto rallied?
Yes.
This is something I would expect. Usually, both candidates hand out good promises to the public, which are, they will never say negative things about a specific sector. They will usually say, I'm for healthcare. No, I'm even more for healthcare. I'm for tech. No, I'm even more for tech. So uh, these promises should kind of boost the S&P 500 going into your end or not.
I saw the clip as well, and it was confusing because I watched him on. And by the way, some people don't even know who Tom Lee is. If you are if you are into investing, you should not absolutely know who Tom Lee is, especially if you are bullish. I watch him countless times coming on CNBC when the
Mhm.
market is having a steep sell-off, and he keeps saying the S&P is up 10% from here, and new all-time high is very, very soon. Always bullish, very bullish. Sometimes people are laughing at him right in front of his face on live TV. So yesterday coming and saying he was non-committal. He was saying in the long term, maybe year end, but in the meantime until the election, he didn't want to say we're gonna get a pullback or maybe a correction, but he was
Mhm.
pointing to that. I don't know if you read something different from him. So what I'm guessing is he expects some quite the volatility. I can see the VIX going up significantly in the next 6 weeks, 5 weeks until
Mhm.
the election. And and maybe everything comes down and we go into a strong year end like we are accustomed to get every end of November and December. But yes,
Mhm.
it was surprising. And if I'm being honest, I completely missed it yesterday. And you told me about it this morning, and I looked at it and I was like, okay, wow. If if this guy not being
Mhm.
bullish when everyone else is bullish, then something is there.
Mhm. So I think the key takeaway now from the way we are investing, you and me at the moment, is ignore the noise. US election doesn't matter.
Mm-hmm.
Um, Whoever wins, also it really doesn't matter. September was a good month while it was supposed to be bad. Everyone expected it to be bad. Year
Mm-hmm.
end is expected to be great, but it could turn out to be bad as well, right? Like there could be a surprise one way or the other. So I think the conclusion we can make from this quarter that just happened is just live your life. Hold the stocks that you believe in, continue analyzing them, but ignore the noise, ignore the short-term noise. Short-term doesn't matter. It doesn't even matter who's going to be the new US president. So this being said, there's another thing that we need to pay attention to, and I think that really has a lot more influence than US election, September, Christmas rally. It's what the Fed is doing and the US central bank.
Yeah.
Everyone says, don't fight the Fed.
Mm-hmm.
And usually people disagree on everything in the markets and on Wall Street in particular. But I think there's a general consensus about don't fight the Fed.
Yeah.
And this is the second topic that I wanted to discuss with you because this is not short term. This is much longer term. Now
Mm-hmm.
we're talking about the next, 3 to 5 years probably, that the new cycle of monetary policy will impact the markets on. Um, I was surprised. I was very surprised actually to see a mega interest rate cut from
Mm-hmm.
Powell. I actually expected them to go slowly because when they do when they take a big decision, they usually prepare the market. There's
Mm-hmm.
some rumors, and markets somehow are not surprised. But I think a lot of people were surprised that there was going to be a 50 basis points cut. Um, the Fed tends to be more conservative than the market. When the market expects, is hesitant whether it's going to be 25 or 50, I assume that it's going to be a 25 because the Fed and Powell are usually more conservative than the market.
Mm-hmm.
What happened is we had the interest rate, the terminal rate at 5.5, 5.25 to 5.5. For simplification, I will say the highest, 5.5. And he cut it to 5. And in the dot plot of the Fed, it's expected that they will cut another 50 basis points this year, so
Mm-hmm.
go down to 4.5. And
Mm-hmm.
then next year is expected at least 100 basis points of cuts. So it's going to be around 3.5% interest rate at the end of next year. That's roughly in line with the US Treasuries, the 5-year US Treasury that we have at the moment, the rate 3.5. But still, in the polls, a lot of analysts and a lot of market participants expect that they will cut even more than that. So it's never enough actually for the market.
Yeah.
Um, and the question here is, it doesn't matter. It probably doesn't matter, but this, my point of view, it doesn't matter at what terminal rate we end. It can be 3.5 or 3 or even 2. I think it doesn't make that much of a difference, 1% interest rate difference. What matters is the direction we're heading to. And we know now that the new cycle has started where we're going into stimulus, or
Mm.
at least into less restriction
Yes.
and into less tightening. And we now in that direction. So there's a clear shift that we're going to cut interest rates. Um, so how do you trade this new monetary policy cycle? Does it matter to you whether the rates are high and increasing or whether they are like now going down? Does it somehow impact your portfolio allocation? I know that you stick with your 20 or 25 stocks that you have, and you're not, you probably have around 20 stocks, I think,
Mm.
and that you're not going to change them, but you might play with the weightings of them,
Yes.
right?
Yes. So let me take this from the beginning. I was surprised too for the 50 BPS cut because until 3 days prior of the FOMC meeting, I was convinced it would be at 25. But then
Mm.
something weird happens. Suddenly everyone, mainstream media, start talking expecting 50. Then I made a post on LinkedIn and on eToro about Jeffrey Canlack, the banking, saying that we'll get a 50. And I believe some kind of a leak from the Fed just to prepare the markets that we're getting a 50 because it was talked about. So the market somehow expected it. If nobody's talking about a 50 and then drop a 50, then
Mhm.
you get craziness. We didn't get craziness. The market took a day or two to digest the new reality. So I was surprised because usually, if not always, the first cut, which is a 50, it happens during a crisis. It happened during the dot-com bubble. It happened during the
Yes,
global financial crisis. So
correct.
with history, you weren't expecting a 50. But in the last couple of days, they just got into our heads that we might get a 50 and we got a 50.
That's
From
even more surprising as the economy is, is doing good. The GDP is doing good. It
yes,
looks like it's growing. Sure, it's data from yesterday.
yes,
It's not data from today, so it's data from the last couple months. It's always in the rear
yes,
mirror that we look in, but labor market is also okay. It loosened a little bit, but it's still very good. It's a very good
yes.
labor market. Unemployment is at a dream rate, I think 4.2 or 4.3% is excellent. Economy is still growing. So how do you trade this shift in monetary policy, this abrupt shift where it looks like we're going to cut interest rates very quickly, and how do you trade that?
So I'm not gonna completely change my portfolio and just go full on Tesla and Bitcoin and all that. That's not my style, and you know it. So,
Mm?
but I would try to maybe add a little bit of the way in some of the sectors that they will benefit from rate cuts. And
You will call me a stalker, but I saw yesterday that you increased your worst position, which is NIO.
yes,
So I suspect that you did it because of the rate cuts coming and the China stimulus, that
yes,
there's going to be an increased demand potentially
yes.
for cars in the US,
Mhm.
and that generally the vehicle sector is going to do better with more demand. Rivian is not, I think, is not really selling in China now, but the Chinese demand will increase for other vehicles.
Mhm.
And so the demand will somewhat shift indirectly to Rivian. Um, is that the kind of play that you mentioned? It's still your smallest allocation,
It's a smallest
but
allocation. It doesn't make a difference
yeah.
if I get it wrong. That's why it's my smallest allocation. Those speculative plays that I do, I keep them very, very low because I don't want to lose the point of what good investing really is. But you're allowed to take some speculative play with 1 or 2%
Mhm.
portfolio, especially when I'm having a good year. So
Yes.
so in America, it's not like Europe. In Europe, we do most of our buying with cash. In America, it's credit. So you might be looking like handsome and rich driving a Tesla, but you're probably paying that Tesla. It's a lease. You didn't buy it
Mhm.
cash. It's a lease,
Mhm.
and that lease payment is dictated on the interest rates. Okay.
Mhm.
So when interest rates are high, some sectors, housing, builders and all that.
We will go actually, we'll do a little marathon sector by
Oh,
sector. I prepared this for you. I
okay.
didn't tell you in advance because I wanted your spontaneous answer. But before going sector by sector, like you were just going to do now, I noticed that 20% of your portfolio, you're gonna call me a stalker again, but 20% of your portfolio is in UNH, Berkshire, and Walmart. And
Yes.
those three, UNH, healthcare, Berkshire, Warren Buffett,
Mhm.
and Walmart, which is consumer staples,
Yes.
it's when the whole world is going south, or that you're expecting the whole world to go south,
Yes.
that you go massively into these three stocks,
Yes.
right? So it feels like you're being extra careful. Perhaps you want to preserve the good performance that you achieved
Mhm.
this year.
I'm always being careful because it doesn't mean that you can't take some risk with a little bit more high valuation stocks, but some companies are just good companies, you know. I mean, Walmart, I know Walmart going to exist for the next 100 years. If something happens to
Mm,
me, God forbid, and you leave the portfolio as it is, it's not going to go to zero because I have companies in there that have been around for so long and they are so well
mm,
run. I mean, for forever, we're going to need healthcare. And okay, Berkshire Hathaway, maybe when Warren Buffett, sometimes to Warren Buffett, maybe I'm going to have to reevaluate my position there. But
Mhm.
so most of my top heavy positions are based on really good companies that perform well in whatever the environment. And so it's good to be offensive and defensive at the same time. And as long I'm getting a good performance, then there's no need to change and just go full on risk, because underneath the UNH, it's a big chunk of NVIDIA. So you have to mention NVIDIA underneath the UNH position.
Mhm. Yeah, correct. And actually going through those sectors, because we're little by little going in that direction. I was actually preparing now the little list. In the S&P 500, you have 11 sectors, and that's
Mhm.
going to be a little game that, a little challenge that I want to take with you. We have 11 sectors, and I tell a sector, and you tell me um, whether the monetary policy shift is good or bad for that sector. So you just answer with outperform or underperform,
Okay.
okay? Or hold. Hold is middle, but I don't want
Yes.
to hear too many holds. Don't say just
Okay.
hold on everything.
Okay.
So I will go from biggest sector to the smallest sector by weighting of the S&P. The
Okay.
biggest sector in the S&P is technology.
Outperform.
Outperform. So you're saying the monetary policy, lower rates is good for tech.
Tech is whatever the environment is good for tech.
Whatever they
Whatever they-
so okay, so it's a perma outperform. So it's
Yes.
not an
Yes.
outperform because of the rates. All
No.
right. Financials.
Outperform.
Outperform because of lower rates or
Yes.
perma.
No, because they're sitting on a lot of unrealized losses with the bond purchases they made uh, 18 months ago. So it's going to be
Mhm,
a relief for them to cut some rates. And besides that, I'm not betting on the small regionals. I'm betting in the big guys, the Goldman and the JP
mhm,
Morgan, the Bank of Americans. That is not just banking, is investment banking, is IPO underwriting.
mhm.
So good markets, bullish years, they tend to do well.
Mm. So for tech, actually, I have the same opinion as you. You know, I'm bullish on tech no matter the rates, because anyway, most of the companies don't have much leverage in the tech sector, and they don't need the consumer to get debt to consume,
Yeah,
technology products. So tech is perma bull in my case, but financials for me, and you were getting there actually. For me, it's a mixed picture, because it depends on the type of
yes.
financials, right? So some benefit from higher rates, some benefit from lower rates.
Not
Uh,
a
in my
bank.
case, in my case, for example, I like BlackRock. You like JP Morgan. I really love BlackRock.
Yeah.
BlackRock arranges a lot of transactions and is involved in a lot of transactions and collects fees depending on the valuations of the companies.
Yes.
And lower rates push up the number of transactions and valuations. Yeah. But smaller regional banks, more traditional ones that collect interest rate on the lenders, on the retail lenders, they might suffer a little bit here.
Yeah, not all banks are created equal. Some banks are run by
Yeah.
Jamie Dimon, and some other banks is run from a guy doesn't know what he's talking about. So, I mean, it's
Yeah.
unfair. It's unfair.
And then next sector, healthcare. Higher rates, good or bad for healthcare stocks?
Oh, you mean lower rate?
Sorry, lower rates.
Yeah,
Lower rates. Apologies.
yeah, I'm bullish on outperform for the healthcare.
Really, I
Yes.
think it's going to underperform, and I'll explain why. I think it will underperform not because so healthcare might still be green and
Mhm.
perform good next year, but it will underperform the broader market, in my opinion, because the demand for healthcare is completely unrelated to interest rates.
Mhm.
So you don't have more people getting sick when the rates are going down.
Yes.
You have quite a stable demand for healthcare, growing a little bit every year in the US, every year by around 3% or whatever, couple percents the demand increase for healthcare because of aging and because of inflation. And so prices rise, earnings rise, a little bit of healthcare. But I don't see it really outperforming. For me, healthcare is something a bit like consumer staples. Like I put them in the same category where they are essentials for the patients, for the customers. We call them patients in the healthcare sector. You're not going to have, people hit by cancer being like, all right, the rate is lower now. Let's borrow a lot of money and cure myself.
Yes.
Because even if, when the rates are high, they still take on that depth. They're not waiting to hear what Powell is going to say. It
Mm.
doesn't have any effect on, their cancer cure. So from that aspect, I'm saying that healthcare is going to underperform the other sectors like, tech and financials.
Yeah, for me, healthcare is in a secular, uh, it's a secular bull case. Bull,
Yeah.
not case, bull
So
run.
it's
Well,
not related to rates. Yeah.
no, not really. No, not
Mhm.
really. But in a bad economy, in a bad market, definitely outperforms.
Yeah,
Healthcare
definitely.
definitely outperforms.
Definitely. Healthcare and consumer staples. Agreed.
Yes.
Consumer discretionary. So let me just define quickly for our audience. Consumer staples are essentials that the consumer needs, so
Mm.
food and the like, right?
Yes.
Consumer discretionary, it's more like, brands, e-commerce goods,
Mm-hmm.
and things that are not necessarily essential for the survival of the consumer, right?
Yes.
So it's more related to status, pleasures, entertainment. So how do you see consumer discretionary performing? I guess we can guess your answer already because of what you mentioned that in the US, a lot of people use credit card
On the
for their
credit card, yeah.
purchases.
Whatever you can put on the credit card is going to do well when the rates come down. Uh, but that depends also in the okay. So to put it in context, let's assume we're going to have a good economy and the rates are coming down. Because if we don't have a good economy,
Mm,
let's say go into a recession, but the rates are down. I mean, doesn't matter if it's minus 20 for the rates. If you are in a really bad recession, it
yeah,
doesn't really matter. So let's assume that we have a good economy and rates are coming down. Yes. Uh,
yes.
consumer
Uh,
discretionary, yes, outperform.
Yeah, I probably should have specified it. The base case here is the economy stays as it is, because
Yes.
this is also what's plotted by the Fed. Of
Mm-hmm.
course, if there's a recession and everyone lose their jobs, the
Mm-hmm.
rates can be at zero. They're not going to be able to
Yes.
afford anything
Yes.
anyway.
Yeah.
So yes, we assume that the economy is stable, employment is somewhat stable,
Mm-hmm.
and the rates are going down. So consumer discretionary. So I'm thinking here Nike, LVMH,
Mm-hmm.
even Amazon, Tesla, which you mentioned also earlier. I think
Yes.
these are likely to perform pretty good. Tesla is not, it's sometimes considered consumer discretionary, sometimes technology. I mean, no one really knows
A
where to
combination
place.
between the two, but Amazon, in my opinion, is a consumer stable.
All right.
Me, Amazon for me became a consumer stable the
Yeah.
moment you have in subconscious to say, why do you get that? Okay, let me look on Amazon. Once the
Yeah.
human mind, the first thought of shopping something online is on Amazon, then it's a consumer stable.
It became the online Walmart basically.
Yes,
And
exactly, exactly.
yes, so Nike, LVMH, and other brands likely to outperform if the economy stays good, rates go down.
Yes.
Industrials.
This is a tricky one.
That that includes manufacturing.
Yes.
Maybe I can go first because
Yeah, please
I
go
really
first.
like industrials and my
Yes.
portfolio is quite heavy on industrials. I think they're going to be pretty good
Mhm.
because industrials are the backbone of the economy.
Yes.
The industrial sector produces all the stuff that people need. And if the economy is good and the rates are lower, there's more demand for stuff, just to
Mhm.
put it simple. And secondly, industrial companies, they usually have high leverage. So
Mhm.
there's going to be a relief for them to have lower rates and they can refinance themselves because they usually have a lot of debt. But I also understand that it's not going to outperform necessarily something like consumer discretionary or tech, but
Mhm.
it's still going to perform a little bit better than average, in my opinion.
That's what I stand to between hold and outperform because
Mhm.
industrials are very highly capital like um
intensive.
intensive industries, and then most of them they pay a dividend.
Mm.
So, and they pay a high dividend, more than 1%. Most of them are like in the 2 or 3s. A lot of them are in the dividend aristocrats. So it's a lot of pressure to have such high rates and do that as well. So I think it's going to be a relief. I agree with you, but I put them between the hold and the outperform. It's a case by case. It's a case
Yeah,
by case. Not all industrials are like created equal, in my
yeah,
opinion.
yeah, absolutely. It's a very wide sector, and
Yes, yes,
you have big differences within the sector.
yes,
Consumer staples, we already touched base here on that. Economy
yes.
good, lower rates. Are consumer staples performing better or
Um,
worse?
I think it's a hold. It's a hold for the consumer staples if the economy stays as it is. Again, it's a case by case. For example, Walmart and Target in a good economy, they perform the same. In a bad economy, Walmart outperforms because Target is like they sell the exact same stuff, but a bit more expensive in a fancier store. So when you get a recession, then you don't care if they have fancy lighting into the store. You just want to
Mm,
get your steak as cheap as possible. So that's when you go to Walmart. That's why I'm so heavy on Walmart. And
mhm.
the reason, by the way, I'm so heavy on Walmart is not just for the case something goes wrong, but um, Walmart and Amazon expected to be 30% of all commerce in the United States in the next by 2030. So 30 cents of every dollar of everyone in the United States buying
Mm.
is going to be revenue by them or Walmart. So
That's insane.
that's insane. Yes.
Yeah. Next one, energy.
Okay.
Good economy, lower rates.
That's a tricky one. I go with hold. With I'm going with hold because I don't have a reason to say outperform, and I don't have a reason to say underperform. So if I have to think about it
Yeah.
for 5 seconds, I'm just saying hold.
Yeah.
So,
Because people will need energy regardless of, of the interest rate. The, demand for energy
mhm.
is not really related to interest rates. Sure, a better economy might need more energy, but I agree with you. It's here hold.
It's a hold.
By the way, I'm noting that you still didn't say any single underperform, and this is mathematically not possible
Yes.
that that all of your options here are outperform and hold. You
We
need underperform,
we
otherwise,
got how many more sectors we have to go?
one, two, three, four sectors. So brace yourself.
Yes.
Materials. So
Ah,
think mining, raw materials. So that's similar to industrials, in a
so
way.
theoretically, on a good economy, when industrials and manufacturing is picking up, then materials go handy with the industrials, correct? At least that's my perception.
Mhm.
Um, China is doing a big stimulus of 500 billion. They just announced it.
Correct. So
So
that's super bullish, right?
that's
For
super
materials,
bullish.
actually.
So okay, let's go outperform for materials.
All right. The next one, you have only three left here.
Yes.
Utilities.
Utilities underperform by a mile.
Really underperform.
Yes. Wait. When did utilities outperform? Never. They just hold the ground.
Well, yes. I mean, they market perform most of the time. This
Yeah.
year also they've market performed. They're very low volatility.
Yeah. They have a
Uh,
they have a cap. They have a cap
yeah.
on the valuation. They cannot go above whatever the cap is. So
Yeah,
and
yeah, yeah, yeah.
utilities is the one sector that I'm not touching because there's nothing there. There's nothing exciting. You can't say,
Yeah.
you know what I mean? And the government,
Uh,
it's all over them.
yeah. For
Yeah.
our audience, utilities include things like electricity, waste management,
Yes.
water,
Yes.
internet. So the demand for those things are really independent from unemployment and from interest rates. And so I agree with you that, I personally would put it mixed, but
Mhm.
in your case, let's leave it in underperform because we need some there. Real estate, that should be an easy one. Lower rates?
It should be an easy one, yeah. This one's an outperform by a lot, I think.
Yeah.
Um,
Lower rates, stable employment.
it's going to take some time though, because you need to get those rates quite lower from what we are here, so it can make a sense for an individual to make a purchase. I mean, you can always refinance, but yeah, it's outperform
Mm,
in the next 24 months. I would say outperform for sure.
mm. And the last sector, which is also the smallest one in the S&P 500, I think it's going to go into your underperformed basket because it has very similar characteristics to utilities. Can you guess which sector I'm talking about? They usually pay very, very high dividends, like really high ones, to
What
the
is it?
extent to the extent
Communication.
that yes, correct, telecommunications.
Communication. Yeah, the AT&Ts and the Verizon. Yeah, I mean those they don't perform. They shouldn't be in the S&P. They shouldn't be like they should be next to the treasuries. You buy them for the yield. You know how much it's going to be end of the year, the price
Mm,
around within a couple of percentages. And also there's nothing there. But instead of
mhm,
buying bonds, I would definitely buy Verizon before I buy bonds. Uh,
mhm.
because you know what
Yes.
you're gonna get the yield. AT&T, I'm not a big fan of it because they have so much debt, and
Mhm,
just a ticking time bomb. AT&T,
mhm.
I don't know
Yeah,
how long they're gonna keep this going and paying that
yeah,
ridiculous amount of dividends. But yeah, there's
yeah.
those two sectors for me, utilities and telecommunications. There's nothing there. And I
Mhm.
think at some point they're gonna get them out of the S&P.
Yeah, maybe into the Dow Jones Industrials and stay there.
Yeah.
Um, Actually, for me, for both sectors, telecommunication utilities, I said it's a bit a mixed picture because both usually have high leverage
Mm-hmm.
on one end, so it's going to be a bit of relief to have lower rates. So
Mm-hmm.
that's going to boost their earnings. The
Mm-hmm.
valuation multiple will stay the same, but the earnings will be somewhat boosted.
Mm-hmm.
Not for long in the short term when they refinance when the rates have bottomed out.
Mm-hmm.
On one hand, and on the other hand, actually, what I'm thinking, um, I don't know if this is really true and if this is really going to happen, but you had a lot of fixed income investors
Mm-hmm.
enjoying the very nice yields on risk-free US treasuries of almost 5%,
Mm-hmm.
right? Between 4 and 5% the last couple of years. I'm thinking that you have all these people and you have all these retirement accounts and all these old people. We know that in the US, almost all the money, like I don't know, 70 or 80% of the money is in with the boomers. We call
Mm-hmm.
them the boomers, the
Yes.
ones born after Second World War, a couple of years after Second World War. They're the ones who have most of the money, and they're the ones who are heavily financing the US debt.
Yes.
And what I'm thinking with the yield of the US debt that will go down because the Fed is cutting interest rates, so the yield will go down. This is a certainty, and it already dropped by 1% in last few months. I'm thinking that all this money will go into communications and utilities where companies pay dividends sometimes higher than 5%. I don't know now the yield of Verizon, but I think it's way higher than 5%. We're at 6% for Verizon, and
Yeah.
AT&T, we might be at 6 or 7%. Let me check it quickly. Actually, AT&T a little bit lower, 5.15.
Should be
But
higher.
all the money might go there around 5, 6, 7% dividend paying stocks, and it should somewhat boost them or not
I mean, I don't know. I
in
don't
the
know.
short term.
In the short term, I mean, some money they're gonna go to them, that's for sure. But I don't know if the majority of the money they're gonna go there because the
Mhm.
old school, these people, the baby boomers, in the 60s now, 60s, 70s, and 80s. And
Mhm.
the portfolio is almost like the old school put together portfolio, the 60-40. And then as you get older and you are 60 years old, then you get 60% bonds and 40%. Do you know that approach? That whatever your age is, that's the amount you have
Your
in
allocation to bonds, yeah.
allocation. Yeah. So and bonds,
I personally don't think when you're 30 that you should be 30%
I don't
bonds.
think so either. I don't think so either. But that old school of
Yeah.
investors in a time that they couldn't do what we do, that was the thought process. Just put your age into bonds, and assuming you
Mhm.
start at age 35, 40, then it's like the 60-40 portfolio. And then from there,
Yeah.
close to retirement, you make it more bonds so you can get income.
Mhm.
The bonds, though, are
You,
risk-free. You're not losing any money from bonds
yeah.
because the US government guarantees them. They're gonna
Yeah.
print the money, you're gonna lose from inflation, but you're not gonna lose the actual money.
Mm.
So they know that, and I don't know how
And
much risk they're willing to take in their 60s or 70s to buy
yeah.
AT&T. I wouldn't risk a single dollar right now to buy AT&T. I don't know if I was
Yeah. Yeah.
65
Yeah.
year
Yeah.
old
Yeah.
buy AT&T.
You know, when I said that when you're 30, you should go 30% in bonds. 30 today, someone who's 30 is very different from someone who's 30 in the 1950s, right?
Yes.
1950s, when you're 30, you're almost grandpa already. I mean, you probably already have kids, you probably
Mhm.
already have at least one house, and and life expectancy was different. Also, now we're expecting to live, we're saying that most people will live above 100, the ones born after
Mhm.
2000, right?
Yeah.
And so it's also, things change a little bit there from that perspective. And also equities, we probably should do a little dive on it, but equities have been on a bull market since the global financial crisis, since 2008. They have been on an amazing um, bull market, really, since 2 decades now. We should do a topic, a whole episode just about this.
Yeah.
Um, but it's a different world now than it was before the global financial crisis and before the 2000s. And now probably it makes sense to be all in equities.
Hmm.
And as you're approaching retirement, to go into dividend paying stocks, to go into, eventually bonds. But
Hmm.
bonds also look risky because of what you said, that when you look at the deficit and the US debt is so high, and the US government will just print a lot of money, and that will cause inflation, that will anyway kind of remove the return that you're going to make. Now on the treasuries, you can just make 3.5% per year.
Hmm.
3.5, that barely covers inflation if there is no rebound in inflation, right? So equities is the place to be. That's also why we have the pillows of eToro. We are not advertising eToro, but you and me, we both popular investors on eToro. We don't gain anything from having those pillows there. It's just we love eToro. We love to invest in equities there. We love to read the feed. There's always, interesting stuff going on, and you can get a bit the temperature of what's going on in the market,
Yes.
right? On eToro. So that's just a little side note, and that's also our way to show gratitude for the
Yes.
Popular Investor Summit, because we borrowed these pillows from the summit.
You know what? I went to a lot of trouble to get those pillows. To get those pillows for I have to fight. I had to fight Neja, the file night to get one. So a shout out to her, by the way, uh,
Yes.
for letting me keep my pillow. Uh,
Yes, if she's listening to this, hello Neja, we are waiting to have you also on our podcast, and
yeah,
I think we will have you very
yeah,
soon as a
do it. Yeah,
guest.
we're gonna have
Yes,
her on and talk about markets with her as well.
very good. Thank you. Thanks a lot, Dimitri. I think it was a very comprehensive discussion we had today about going into the end of Q2, ending September, going into the US election, going into a lower interest rate environment. And hopefully you found this episode interesting. And yeah, don't hesitate to leave your questions in the comment section. Thank you.
Leave your questions and stay tuned. We have a lot of popular investors are doing the podcast in the next month or two, so stay tuned. It will get exciting.
We have great guests coming. All right. Bye, guys.
All right, bye, guys.